Today's topic is depreciation, and first we will understand what is depreciation. Basically, any asset that we use in the business wears and tears with time. So we actually have to reduce the book value of the asset. For an example, the book value of an asset is 1 lakh. That is the cost of the asset, the price at which we have bought it. But at the end of 1 year, it will not remain 1 lakh anymore. Because if we want to sell it, its price will reduce, its efficiency will reduce. So, we will take, for an example, a certain percentage reduction. For an example, here we are taking 10%. So, if we reduce this by 10%, so 10% of 1 lakh is 10,000. So, now after the depreciation, the value becomes 90,000. That is 1 lakh that was of the cost of the machinery minus the value that is depreciated in 1 year. Over here in this example, I've taken it as 10% per annum, that is yearly 10%. So this becomes 90,000. So we can conclude that at the end of the year, an asset that costed 1 lakh becomes 90,000. So this is depreciation in short, and there are two methods as I told you. One is SLM, and that is straight line method, and the other is WDV. The difference in SLM, a fixed amount is deducted from the book value of the asset every year. That is 10,000 for an example, then every year it will be 10,000. But in case of WDV, which is known as written down value, the amount will vary, that is, it is variable. The rate may be fixed, that is 10%, but it will be on the reduced value, that is on the depreciated value each year. Therefore, the value, the depreciation, the amount to be depreciated reduces with time. Now we're going to straight on jump to the sum. See, it's given that the following balances appear in the books of Satish Brothers of on 1st April 2022. Here we have got an accumulated depreciation account and a machinery account. Whenever we come across things like this, it actually denotes that we have to make two kinds of account. One is only machinery account and another is the provision for depreciation account. Provision is because we know that whenever we are purchasing a machinery, its value has to be reduced. So that is why we'll make a provision for it beforehand, and we will reduce the value to be depreciated every time from the provision account rather than changing the balance of the machinery every time. So the first thing that we have to do is see, it's given that on 1st April 2022, here the machinery account was 1 lakh on 1st April 2022 and the accumulated depreciation is 36,000. Now on 1st April 2022, they decided to dispose means sell off, the machinery for 8,000, which was purchased on 1st April 2019 for 20,000, which means the machinery that costed us 20,000 in April 1st April 2019 has now being sold off in 8,000, and we have to find out whether we are in profit or loss because we have sold it off on 2022, that is 2 years after the date we have purchased. Therefore, in this 20,000, there will be depreciation for 2 years. So let's calculate it. First of all, what we have to do is we will first calculate the simple depreciation for the machinery that we are selling. So first we will start off with the cost. Now the machine that we are concerned with, its cost was on 2019. So it's 1st April 1419. Its cost was 20,000 as per it's given in the question here. 20, it was 2019, it was 20,000. Now depreciation will be for the whole year, that is till 31st March 2020. So we will write the next date, that is 31st March, the year end 2020. There will be a depreciation on it, and the depreciation value is given. You can see it's written down value of 10%. So 10% of 20,000, that is, we will calculate here 10% of 20,000 is for the whole year. So 10% of 20,000, which comes down to 2,000 if we calculate it. and this is what is to be reduced from this. Now the asset value reduced by the depreciation is 18,000. Now this is what is standing with us on the 1st April 2020, the written down value. So we can write 1/4/2020. It is the WDV, that is the written down value. Now we will again move to the next year's depreciation, because you can see it was sold on 21st April 2022, which means 2 years of depreciation, 1 year done here and another year to be done. So again, we will put the date as 31st March, and this time it will be 2021. And now again we are going to depreciate it, but this time the depreciation, because we are taking WDV into consideration, so this time the 10% depreciation will be on the reduced value, that is 18,000 instead of the 20,000 cost. So 18,000, 10% is 1,800, so this is to be reduced. Once we reduce it, 18,000 minus 1,800, we get 16,200. Now you can see it is sold on 1st April 2022. So we are left with one more year. Now this is standing on 1st April 21. So next year, 31st March 2022. Again there will be a depreciation, and this time again 10%, but on the reduced value. So 10% off, this time it's going to be 16,200. So it is 10% of 16,200. The simple calculation, 1 0 will get reduced. So it will become 1620, 1620. Now this get reduced. So 16,200 minus 1620, 1620, it comes to 14,580. So this is my written down value on 1st April 2022. WDV. Here also this was WDV. Now we are done with it. This is what we are left with, 14,580 of the machinery we were talking about. Now this is sold for 8,000. So therefore we are going to write the selling price here. And you can see it is sold on 1st April 2022. So the same date, 1/4/2022. I'm using a different color to explain that this is for sale. Now it was sold for 8,000. So you can see here the cost price, that is the amount that we are left with, is 14,580, and we sold it for 8,000, which means calls for a loss because the selling price is less. So my loss will be, of course, the cost price, that's the greater value, minus the smaller value, that is the cost price minus the selling price. So 14,580 minus 8,000, if we calculate, it comes to 6,580. So this is what the working is all about the disposed of machinery. Now we are going to straight away make the accounts. The first account that we are going to create is the machinery account. We are going to prepare two accounts, machinery and provisioning. Now first we are going to prepare the machinery account. As I told you earlier, in case you are making the provision account, we are not going to change the value of the asset every time. So therefore we are going to begin with the balance. We are making a T format. Very rough form. So this is my particulars, and then we have got amount. Again, particulars and amount. I haven't made the date column here. I'm going to include it with the particulars itself because I don't have much space here on the screen. Now you can see it was stated in the question that the machinery account, see here, had a balance of 1 lakh. So we're going to start with 1 lakh. We know machinery is an asset. Therefore, it's a debit balance. So we're going to begin with a debit balance, that is here. So debit is this side. We know this side is called the debit side and the other side is called the credit side. So because asset is a machinery, it's an asset. That's why we're going to write it here on the debit side. So we're going to write 2 balance that was given to us brought down, because it is brought down from the previous year. That's why BD. We are going to write 1 lakh. Though we don't have space for the date, but we are going to mention the date as well. It was as on the 1st April 2022. We'll put on the date here. It is 1st April 2022. Now, what we are going to do is, we'll move to the next one. Over here, uh, we have sold the machinery. So we are going to write to bank, and we sold it on which date? The date was, see, it is given over here. It is sold on 1st April 2022. So we are going to write the date 1/4/2022, and we are going to write to bank. Sorry, buy bank. This is the buy side. So we are going to write buy bank. Because whenever an asset is sold or purchased, we do not write purchase or sale account. We instead write only bank account because it's an asset. So by bank, this is actually the sale, and by selling it, we have got 8,000 as stated in the question. And there has been a loss. Instead, in case of loss, is going to be on the credit side, we know. So the loss was of 6580. So we are going to also write the losses over here. 6580. This is my loss. So we're going to write by PL, and this is basically the loss, and the date will be the same. 1st April 2022. The day we have sold it, the same day. Now, over here, another thing that we have to take care of is the provision for depreciation account. As I told you, here we are going to prepare the provision account, and this is the provision account that we're going to prepare shortly. Now, in provision, we are going to write the whole provision that was made, that is the depreciation that is made. So for that, we have to calculate the total depreciation. Now, how can we calculate the total depreciation? For that, what we need to do is we have to calculate the depreciation for the year. How is that possible? See, we are going to add up all the depreciation. Here we have got a depreciation of 2000, here of another 1620, and here there was an 1800. So if we add all these are my accumulated depreciation. So these are all my depreciation amount. So if we add all of these, my depreciation account becomes, adding all of this, 1800 plus 1620 plus 2000. It comes to 5420. So we're going to write it here. Now this is 5420. We're going to write it here. Provision for depreciation on the same date by provision. This is provision for depreciation. Depreciation. I'm writing dep in short. And it's going to be, as I told you, by adding we are getting 5420. We're going to write it this way, 5420. Now, what are we left with? We are going to see. It was already stated to us. What are we left with? The figure. We already had a 1 lakh here, and over here we have to add all of these. If we add all of this, we get 8,000 plus 6580 plus 5420. It's coming to 20,000. So which means if the balance is 1 lakh and all of these boils down to 20,000, therefore we can write that the balancing figure is 1 lakh minus 20,000, that is 80,000. So we're going to write it here on, this is the last date that we have, 31st March 2023, because the next year begins, it is for the next year, by balance, and we're going to write CD, credited down, and the amount being 80,000. This is the balancing figure. Again, this 80,000 basically moves to the other side here, and we're going to write 1st April 23, and it's going to be 23. It's going to be to balance PD and amount being 80,000. Similarly, over here when we are making the provision for depreciation, So make the account for provision for depreciation. See, over here, it was already stated that the accumulated depreciation account had 36,000 as a balance. And we know depreciation is an expense, okay? And we're making a provision. Provision always begins with the credit side. So we're going to write the balance on the credit side, which is this side. So we're going to write it this manner. This is the particulars. We're going to write the date along with it because, as I told you, there's some problem with the space. So particulars. Okay, and this is the amount section. Now, first, I'm going to begin with the balance, and the balance will be on the date that is given to us, that is 1st April 2022, as stated in the question. My balance, this is a brought down balance. So, my balance brought down is 36,000 as per the question. You can see it's already stated over here in the question itself, 36,000. So, that is what we have begun with. Now, see the depreciation for the whole machine that we have sold. We are going to write it over here because we have already sold it, so we are not going to further process any more depreciation related to that machinery. So we are going to first cancel it out, for which we are going to write it over here. We have shifted this to the machinery account, that is on 2022 itself. On 1st April 2022, there has been two machinery, that is the machinery disposed of, the depreciation related to it. So this is 5420 as per our calculation. We've also rated it over here provision, and this is for machinery. So 5420. Once we are done with it, we are going to calculate the depreciation of what we are left with. As I told you over here, because we are making the provision account, we are going to write all the depreciation over here. So on 1st April, no, on 31st March 2023, that is the last date, we are going to calculate the depreciation. So it is by depreciation, writing it in short. Now see what happens is, already now my balance was 1 lakh, but right now my balance is not 1 lakh. 80,000 gone. 20,000 gone from there, sorry, because the machinery costed 20,000. So now we are left with only 80,000, and also we are not left with 3,600, that 36,000 that we had begun with. From here 5420, that is the depreciation related to the machinery sold, is also cancelled. And now whatever we are left with, 10% of it, because we are using WDV method. So over here we have reduced the value of the machinery, and over here the accumulated depreciation that we had. So 1 lakh minus 20,000, it is 80,000, and 36,000 minus 5420, it comes to 3580. So if we calculate it over here, this is 3580 and this is 80,000. Add both together. Adding both together, we get 1 lakh and 580. Sorry, not adding, deducting. So 80,000, that was the machinery value that we had, and right now the reduction of the total depreciation, that is 3580, we get 49,420. Now we are going to calculate 10% of this. This is very simple. The zero will get omitted if we multiply it by 10%. So right now we can say that our depreciation is therefore 4942. Now we are going to simply calculate, add both the sides, and we are going to find the balancing figure. Here we have got only 5420, and here we have got a bigger figure. So add these two. If we add both of these, we get adding both these together, we get 4942. So this is our balancing figure. This is our total balancing we have to find out. It was 4942, and from 4942 we're going to deduct 5420. Once we do it, we get the balancing figure, that is 35,522. So this is our balancing figure we're going to write on the last date, that is 31st March 23, to balance credited down. And this is what we're going to write it over here, by balance. This is on 1st April 23, by balance. This is going to be brought down balance, and as we had written over here, 35522. This is what we are going to write over here as well, 35522. That's it. So we are done with this. So basically the difference is, if there was no provision account, all these depreciation has to be calculated here in the machinery account itself. But here, since depreciation, the provision is being created for the depreciation account, we will do all these calculation related to the depreciation here in the provision account, and the machinery account leaves as it is until and unless the machinery account will only change its balance if we have purchased a new machinery or we sell new machinery. Like over here in this case we have sold it, that's why we have made these adjustments. Otherwise the same balance would have maintained every year. That's it.